looking at the Mrs. Eos Kishor case study on asset allocation. Let's read question 1 and then we'll start reading. Identify the name of the economic phenomenon of the conflict in Asia. Describe the statistical issue that arises in these situations. Kishor works at a global wealth management firm in Turks and Caicos. Many clients who hold portfolios at Kishor's firm, Island Impact Incorporated, are wealthy elites from the United Kingdom who desire increased privacy in their financial affairs. Kishor is a senior analyst at the firm and is in charge of updating the firm's capital market expectations, which the portfolio managers use to manage client wealth. Kishor and his team have been looking at a situation where a larger country has recently attacked a small neighboring country in Asia. The larger country does not recognize the sovereignty of the smaller nation and has begun a campaign to usurp it for political and economic gain. This war is expected to impact global markets that will play out over the coming year. Both countries' currencies have taken a significant hit. However, the invading country has been able to prop up its currency using many capital controls. Kishor wonders what will happen to their equity and bond markets, especially in the face of Western sanctions, and how the conflict will likely change the relevance of the past data the firm used. So let's see. Kishor then turns his attention to his home country, which has been experiencing a heavy bout of inflation, potentially due to the Asian conflict. Anyway, so it looks like all the info we're looking for is in here. And so just to pull in the first part here, so identifying the name of this economic phenomenon, that's going to be two options for answers here: regime change or exogenous shock. Those are the two terms that we could have used for identifying the name of this, which is what's happening with this war breaking out. And so the key thing here is how the conflict is going to likely change the relevance of past data the firm used. So this is going to be, the statistical term here is going to be non-stationarity. And this is basically saying that relationships of certain variables in the past are essentially permanently changed because of the impact of this event. So I wrote a fair amount out here. You can paraphrase a little bit more in your answer, but an event like this is going to have such a great impact that it could have permanent effects on capital markets in relationships between variables, making that historical data to make inferences less helpful or basically irrelevant. So looking at this question, you 3 points. You'd get 1 for identifying the name, 2, a second one probably for properly naming non-stationarity, and then a third one for describing that properly. So there you have it. Question 2, determine the inflationary effect for cash. Briefly justify why this occurs. So we've got where we read to here. Kishor then turns his attention to his own country, which has been experiencing a heavy bout of inflation, potentially due to the Asian conflict. The inflation has been strong, but Kishor believes it is likely understated and will continue for 2 or 3 years. Kishor is working with a junior analyst and wants to ensure the mentee understands the effects of inflation on each asset class. Kishor draws up a schematic and asks the junior analyst to fill it in over her lunch break. Kishor wants the analyst to write positive if the effect of inflation is expected to increase asset prices, neutral if uncertain, and negative if expected to lower asset values. So we need to determine positive, neutral, or negative for each of these asset classes, but for this question specifically, we're looking at cash. So this cash is pretty tricky here. This is going to be a little counterintuitive, but this is actually going to be a positive effect. So inflation is typically going to lead to an increase in interest rates, and because cash or short-term deposits have basically zero or very little duration, interest rates are going to increase, and so short-term deposits are going to be able to be reinvested at those higher rates. So this is going to be a positive for cash because they have zero duration, they're not going to get hit on a price standpoint, and the returns are going to be better going forward because we'll be able to be invested at those higher rates. So a little counterintuitive, but if we're investing in short-term deposits, that the interest rate sensitivity is the importance there. Question 3, determine the inflationary effect for fixed income. Briefly justify why this occurs. So this is going to be a negative effect on fixed income, and the reason this differs from cash, so we said with cash, basically rates are going to increase, which has little price effect on cash because there's no duration, and then we'll be reinvesting at higher rates. For longer term fixed income, it's going to be kind of that opposite problem. So we have more duration and sensitivity for fixed income assets. So we're going to see that immediate price drop because we have more sensitivity there. And then we're still going to be reinvested at those. We're going to be invested in those lower yields for that longer time frame. And so we're not going to see that reinvestment for a longer time period. So this is going to decrease the real yield on those assets that we're holding, and lead to that price hit right away. So this is going to be a negative effect for fixed income. And just to kind of detail here, I didn't do it for the cash, but you'd get one answer, or probably 1 point for getting negative right, and then 2 points for kind of properly justifying why. Question 4, determine the inflationary impact or effect for equities. Briefly justify why this occurs. So for equities, we're going to be neutral. In the short run, it's going to vary greatly based on the type of company. So some companies are going to be able to raise prices, and they may even gain on their margins, or they might. So an example of a company like that would be a company that produces commodities. So a lot of time a commodity linked equity, if commodity prices are rising, they may not have what they're selling may be increasing at a greater rate than their costs or inputs. So they're going to have margin increases there. Whereas some companies may have larger increases in their inputs than they would in what they're selling. So in those cases, they're going to see margin compression. So that's a pretty long-winded answer, but basically in the short run, it's going to vary based on type of company. Long run, profits are going to outpace inflation. So it kind of leads us to a neutral, which is kind of telling us that we're uncertain what the effect would be.